Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Conference. And I'm here with Frank Rodilosso, who's head of fixed income ETFs at VanEck. Great seeing you, Fran.
Great to see you, Tom. Thanks very much for having me.
So, income is something that a lot of people are concerned about. Rates at historic lows, but still, we've got that need for income. Take us around the world, and where should people be considering investing for income?
Yeah, well, we've been looking a lot at emerging markets at VanEck. We always do, but we've been out talking about it a lot this year. Partly because there is still yield. There's yield in local markets, there's yield in their dollar debt. So if you take similarly rated investment grade emerging market corporate or sovereign debt versus investment grade US corporate debt, you get a yield pickup, so there's some additional yield in dollar terms. Yeah. Emerging market local currency debt has been particularly interesting this year because some of the currencies have begun to rebound from a multi-year, I wouldn't call it a depression, but multi-year underperformance.
What areas have been rebounding? What areas of the emerging markets?
Well, local currencies have been driven largely by the recovery in commodity prices, so they've been somewhat correlated to that. Also, though, rates in local markets, most emerging market central banks don't have their rates near zero. A few do.
Yeah.
But the average policy rate in emerging markets is around 5.75% to 6%. They've got positive real interest rates. They've got positive growth. They've got inflation in most of those markets. But the boon or the recovery in commodity this year, in commodity prices, has helped sentiment on currencies and it's helped EM fundamentals. So you go farther out the yield curves in some of those countries, you get a little more yield. So it could be Brazil, Russia, some of the perceived more safe countries in Asia. All of them have been places where people have been going for yield this year.
So as far as diversification, do emerging markets get a bad rap? Do they appear in the eyes of investors and advisors to be risky when in fact, if you diversify, they're not as risky?
I think it's true of any asset class or group of asset classes that if you diversify enough, it's a great risk management tool. Emerging markets isn't a single asset class, and the countries are far different.
Right.
You've got countries who are hiking rates, countries who are cutting rates, countries who are on hold, just from an interest rate perspective. You've got single A rated countries down to triple C and below rated countries and companies. So you can also carve up the market and you can decide, I want to be at the safer end. We launched a product this year, IGEM, which is it's emerging market sovereign and quasi-sovereign dollar denominated debt, 80% investment grade, minimum 80% investment grade. The other 20% slice is double B rated, and there's a cap on that at 20%.
Okay, and ballpark yield on that?
It's in the high threes, but it's a significant pickup over, even the IG slice alone of that is a significant pickup over US investment grade corporates.
Okay. And what else? You've been managing EM debt. You've got a few other ETFs in that space.
Right. Well, I mentioned local debt, and EMLC is our emerging market local currency fund. Again, diversification is 15 countries from Latin America, Eastern Europe, Africa, and Asia. So it's geographic diversification. Certainly some economic diversification in terms of how those countries work. That's been, yield has come in from the high sixes to the low sixes on that product this year. But again, as I mentioned, these are positive real rates on average, well above rates. And again, Brazil's yielding over 10%. Some of the Asian and Eastern European countries are yielding considerably lower, but there's diversification there. Some of the countries are commodity importers, some are commodity exporters. They're not all a single trade. So as a fund, it's really interesting.
You take your fixed income portfolio, you put 10% in EM debt, diversified across all the countries. What that does to your overall yield is pretty significant.
It can be meaningful, yeah.
Fran, as always, I appreciate seeing you.
Thanks a lot, Tom.
Thank you.